everyone. My name is Marko Lima, and today I'm going to talk about the recent news and what that means for investors that are actively trading and investing in the markets today. My background is specifically in finance. I've been working in the finance industry for about 3 to 4 years. I specifically focused in the pension asset management side of things as an analyst in operations, and I've also had some experience with investment banking, particularly in the equity capital markets and convertible bonds. Basically, I just live and breathe this stuff. On my free time, I like to do a lot of equity analysis and just like doing some due diligence for my personal investments. And honestly, this is something that has allured me over a long period of time. And I think that it's beneficial to go through the learning process and share it. Like, why not? I remember when I was younger, I wanted to get this sort of information and get some insight from different perspectives, and there just wasn't an availability of that. Of course, there's always a bunch of people that are always maybe on YouTube, maybe there's people on social media, but their background seemed to be mainly like retail investor. I mean, to a certain extent, I am that as well. But what I really want to focus on is more of like the transparency side of things. Hopefully, through my learning process and through the experience that I go through, hopefully it helps you get a little bit of an advantage, a little bit of an edge when you execute your investments and your overall financial life. So, basically, what I want to talk about today is, man, it's the L of the markets right now. Basically, the big regional banks are starting to fail due to rising interest rates. The Federal Reserve has been pushing a hawkish mentality into the equity markets, capital markets, and the overall macroeconomic environment. This is for a lot of reasons, but it's mainly due to the hyper acceleration of inflation over time in the past few years. And now they're trying to calm that down, trying to relax that a bit. But of course, that always comes at a cost. And with that, we're starting to see a little bit of stress in the markets right now. Big headline that happened in the past few days was SVB, the Silicon Valley Bank that basically collapsed in a matter of days. And the FDIC had to step in and try to calm down depositors and make sure, like, dude, we got it under control. Like, whatever, they did what they did, but we got you. Like, don't worry about your deposits. This is something that hasn't really happened before, and it's kind of setting the precedent and trying to set the tone that, all right, this is something major that's going on, and if we don't stop this right now, then things could get a lot worse. And unfortunately, things have gotten pretty much worse in the next few following days. I mean, First Republic Bank, they've been going through some similar issues where basically Silicon Valley Bank collapses due to poor asset management. And then First Republic, just by association, they have a similar customer base where they're wealthier clients, they're a little bit more concentrated, and then investors just go like, wait, hold on, if this happened with SVB, what's going to happen with FRC stock? And of course, boom, 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 dump, dump, dump. I mean, from what you can see here on the screen, you can just tell like it's been pretty bad in the past few weeks, and it's been a massive sell-off over the past few days, and it just seems like it keeps accelerating. So yeah, not a good thing at all. But people are talking about this way too much, and I don't really hear a conversation about what it means from an investor perspective and what it means from an asset management perspective. So like, all right, we can sit around here and make fun of the banks that are failing with their endeavors in terms of investing. We can go around and say like, oh wow, you just took a $2 billion loss on your investments. Right. Oh, you just took a $2 billion loss on your investments. What a loser. Like, oh my gosh, this is such a horrible management of such a massive bank. Like, and this is happening multiple times. Like, look what's happening with Credit Suisse. They take multiple L's year after year. They have scandal after scandal, and all of a sudden they're down so much that they have to basically merge with UBS, their main rival in Switzerland. Like, there's so many bad things that are going on that it's easy for us as investors to be like, oh wow, it's just everything's going wrong. But hold on, what does that mean for you? And one thing that I don't think people are talking about enough is the fact that there's a common denominator in a lot of these big corporations that are starting to fall apart, and that is what's called concentration risk. With SVB, one of the key components to their losses is obviously their management of their bonds and the unrealized losses that they basically had to realize when depositors started withdrawing their money. So obviously that's a huge loss. But what happened is the reason why a whole bunch of depositors start pulling out all at once is because they're basically like the same type of investors. They didn't have a wide, diverse array of different types of depositors. It was Silicon Valley, VC, venture capitalist, tech startup type of customer base. And obviously, this is more business related. So they had large funds that were largely not regulated by the FDIC, probably millions and millions of dollars on an average deposit. And when you have that mixed in with a fear of the fact that, oh, maybe this bank is not viable, maybe things are not straight over here, well, all right, we're going to have to pull out. And honestly, if one person does one thing, a person of a similar caliber is probably going to do the same thing. So it's kind of like that herd mentality. And in this case, it's completely warranted. It's obviously fine when you say like, all right, this is clearly going wrong over here. If I try to pull out my money and they can't cover my funds, oh, we're gonna have a problem. All right. So that's concentration risk in terms of SVB. But for First Republic, they have a similar issue. What did they have? For First Republic, they have a very wealthy customer base. It was honestly at one point a very enviable position that First Republic had while we were in a bull market, because that wealthy customer base was depositing their funds and they had a whole bunch of assets to manage. But again, the concentration risk is that you don't have a wide, diverse array of depositors. And when you have that, you have all these wealthy individuals that are like probably market savvy. They probably understand what's going on in the economy and they at least know what's going on with money right now. Well, they're all going to see the news. They're going to say like, next door neighbor, SVB, just collapsed. If I had to take a bet, I would probably say FRC is probably doing the same thing, or at least something similar. And of course, just through heuristics, just through saying like, all right, let me put two and two together. All right, you know what? Screw this. I'm pulling out. It's done. I don't want to deal with it. I don't want to worry about it. I might as well just move my money into a big bank and sleep well at night. All right, so they do that, and FRC is suddenly susceptible to that concentration risk. They put too many eggs in one basket, and that sucks. Obviously, when things are going well, they're getting crazy returns. They're doing well. They're doing great with deposits. And in a low interest rate environment, you don't even need to get that crazy level of double-digit returns every single time. You can get single-digit returns and still make a nice spread. And with a high asset base, you're talking about millions, billions of dollars easily. All right. But as soon as the Federal Reserve raises the rates, it's over. It's over. Now it's a different type of game. With Credit Suisse, it's a similar story. Honestly, there's been a whole bunch of different scandals that the investment bank has endured over the past 5-6 years. But a big one that stood out to me was the whole issue with the Archegos capital management. So what is this? This one's a crazy one. It's basically a private firm, asset management firm, that literally just works under one family, the Bill Huang family, where it's basically just one investor, where he was so good at asset management, he was so good at investing and picking and choosing different stocks, that he built a good capital base. And once he built a good capital base, he became an accredited investor where he could go to these big banks like Credit Suisse, like Citi, like Goldman Sachs, and just basically say like, look, I'm going to invest in some fancy derivatives. I'm going to invest in some fancy contract, and I'm going to try to leverage that position. I'm going to go on margin. If this sounds familiar, it's because it is. This is basically what the meme stock traders were doing in 2020, 2021 as well. They were going all in on margin, they were going all in on certain investments, and they were only picking 1, 2, 3, 4 stocks. All right. Well, Bill Wang was the GOAT of this. All right. He was trading a specific total return swap, which is a fancy derivative investment that basically just means that, okay, you go on margin and you basically get to realize some of the gains of a stock without actually owning it. All right. Well, what happens is he takes certain bets on certain stocks and he has to get a loan for that amount because he doesn't have all the capital. All right. So what does he do? He goes on Goldman Sachs' door, he goes to Citi's door, he goes to Credit Suisse's door, and he knocks and he goes like, dude, I need some money. Trust me, bro. I'm going to make this back. And just trust me on this. Like, I'm going to kill it in the market. And great track record, great credit, accredited investor, killing it. All right, so these banks are looking to get some returns on their investments. So they say, all right, we'll loan you the money. All right. So a whole bunch of banks give him the money, including Credit Suisse. And unfortunately, he fails on a big investment. All right. So he gets margin called. All right. And now he has to pay up. All right. But it's such a big loss that he can't cover all of the portfolio losses. All right. So he can't pay back the people who gave him the money. Credit Suisse was one of those people or one of those institutions. And essentially, he ends up losing $20 billion in his portfolio. All right. But there's another piece to that, the equity that he owes to the people who lent him the money. And that's Goldman Sachs, Credit Suisse, and all the other big banks that knocked on his door. Now it's basically a race to pull out as fast as possible. They're trying to get that money because it doesn't exist. So whatever is left is what they're going to try to recuperate. All right. So everybody's racing. And now it's a game of musical chairs, basically, where Credit Suisse is trying as fast as possible to get that money back. But unfortunately, it's last. And now it has to take that big L. Apparently, they lost like $5.5 billion just on one investor. If that isn't concentration risk, then I don't know what is. So this is basically what's been going on as interest rates start to rise. It's a classic example of how interest rates can affect the economy and how they can affect business decisions. But what does that mean for you? This is the thing. Just because it happens to a big bank or a big corporation or a big investor doesn't mean it can't happen to you, even if you have a small amount of capital. So how can you relate this to yourself? It's pretty simple. This is the thing, all right? If you invest in 1, 2, 3, 4, 5 stocks, you have concentration risk. Why? Because you're only focused on a specific select few stocks, all right? If you're only invested in stocks, all right, you have concentration risk. Why? Because you're not diversified against different types of securities. What if you're only invested in US stocks? Well, there you go. You have concentration risk because now you're only betting on the US market, the US economy. And you can slice this and dice this in so many ways. But what you have to realize is that when you're investing and you're getting crazy returns, yes, that's really good, but that's not for no reason. You got those returns because you deserve them. You took a ton of risk. Even if you're betting on the S&P 500, you're basically betting on the US economy doing well over time. That's a pretty big bet, especially right now with the current political environment. We don't know what's going on. China's killing it. Russia's killing it. Everyone's killing it all across the board. Some people are taking L's. Some people are kind of shifting their positions. You're taking risk, all right? So when you see those 20% gains on your portfolio, it's not for no reason at all. You're taking that risk and you have to be aware of that. For SVB, they were getting crazy returns on their asset management. They were getting a great customer base. It was almost enviable. Same for FRC stock. But when things change, that's when you have to change your entire strategy and you have to see, all right, am I willing to take on this risk? Unfortunately, SVB, Credit Suisse, FRC, they realized this a little bit too late. And honestly, a lot of it was maybe bad luck or certain scenarios, but dude, they were warned. They were warned months, years in advance when the Federal Reserve said, hey, we might raise interest rates. And a lot of banks, a lot of institutions, they were like, no, you won't. Or maybe you will, but it's not going to be that bad. Like, I got it. When you get those warning signs and you realize how much power certain institutions like the Federal Reserve or the US government or other political factors have, that's when you start to realize, like, oh my gosh, like I might be overexposed. So for you, when you're investing in a stock and you start seeing like, okay, yeah, maybe I'm gonna go ahead with this, you gotta realize what goes through. What are the risks? Because those risks that you are taking is exactly what you're getting paid for. You're putting your dollars where your mouth is. All right, guys, make sure you like, subscribe, and stay tuned for more. If you want, send a little comment. I'll reply if you have any questions or anything. And I'll try to make videos a little bit more often, maybe once, twice a week, and try to keep this going. So if you guys have any specific requests for something that you would like me to cover, just feel free to send it down below and I'll get to it. All right, thanks guys. Bye.